$74 billion. That was Enron's peak value. At its height, Enron looked like one of the smartest and most innovative companies in America. Investors loved it. Analysts praised it. Business media celebrated it. And employees believed they were part of something powerful. But behind that image was a dangerous lie. Enron had built a system that made weakness look like strength. Debt was hidden. Losses were disguised. And the company kept telling the market a story that was not true. Visual: Enron building, Wall Street, rising stock chart. Enron began as an energy company, but it wanted to become much more than that. It wanted to turn energy into a giant trading business. Electricity, natural gas, contracts, and risk were all packaged into the company's story of modern innovation. That story worked extremely well. The stock price climbed, the reputation grew, and Enron became a symbol of corporate brilliance. But once a company becomes famous for looking brilliant, it can become afraid of looking ordinary. That fear matters because when reality stops matching the story, leaders face a choice: tell the truth or protect the image. At Enron, the image became everything. Visual: trading floor, executives, magazine covers. The company used aggressive accounting to make deals look more profitable than they really were. One major tool was mark-to-market accounting. In simple terms, Enron could estimate profits from long-term deals and recognize those profits earlier. Used carefully, that can be legitimate. But at Enron, it became dangerous. Because when you can pull future profits into the present, you can make today look stronger than reality. You can turn assumptions into earnings. And you can make weak deals appear successful long before real cash arrives. That helped Enron keep selling the illusion of growth. Visual: numbers moving from future to present, calculator, earnings graphic. But Enron did not just need to show strength. It also needed to hide weakness. That is where the special purpose entities came in. These were separate structures that Enron used to move debt and losses away from the main company. To investors, Enron looked cleaner. Its balance sheet looked stronger. Its debt looked smaller. But the risk never disappeared. It was only pushed into the shadows. This was the core of the fraud. Enron did not simply fail. It built a structure that made failure harder to see. Visual: hidden debt boxes, balance sheet, cleanup graphic. That is what made the company so dangerous. On the outside, investors saw growth. Employees saw success. Analysts saw innovation. But underneath the image, the business was carrying risks the public could not fully see. The hidden debt still existed. The weak deals still existed. The losses still existed. As long as the stock price stayed high and confidence stayed strong, the illusion could continue. But confidence-based systems are fragile. Once enough people begin asking for proof, the whole structure comes under pressure. Visual: split screen public success versus hidden losses. The psychology of Enron is important too. Fraud does not always begin with one giant decision. Sometimes it begins with pressure. Pressure to hit numbers. Pressure to keep investors excited. Pressure to protect the stock price. Pressure to stay the genius company. At Enron, success became part of the company's identity. And once a company becomes addicted to looking successful, admitting weakness becomes painful. That is when image becomes a trap. Instead of fixing the underlying problem, the system starts protecting the appearance of strength. Employees were caught inside that trap as well. Many trusted the company. Many believed the stock was safe. Some had large retirement savings tied to Enron stock. When the company collapsed, many of those savings were badly damaged. That is why Enron was not just a Wall Street story. Real people were hurt. Jobs were lost. Savings were destroyed. Trust was broken. Corporate fraud is not just about numbers on a page. It changes real lives. Visual. Employees leaving office, retirement chart falling. For a long time, Enron's complexity helped protect it. The accounting was complicated. The structures were complicated. The business model was complicated. And when something is too complex, people often replace understanding with trust. They assume the executives understand it. They assume the auditors checked it. They assume a famous company could not possibly be hiding something that big. But complexity should create more scrutiny, not less. At Enron, complexity helped the illusion survive. Eventually, the questions got louder. Analysts, reporters, and short sellers started asking how Enron really made money. They questioned the partnerships. They questioned the accounting. They questioned the cash flow. And once the questions reached the surface, the story began to crack. That is the weakness of any illusion built on confidence. It can survive while people believe. But once enough people demand proof, the system has to show what is real. Enron could not survive that test. Visual. Headlines, falling stock chart, nervous investors. In December 2001, Enron filed for bankruptcy. At the time, it was one of the largest bankruptcies in American history. The company that had once been worth around $74 billion collapsed into scandal. Its executives were disgraced. Its reputation was destroyed. And the fallout spread beyond Enron itself. Arthur Andersen, Enron's accounting firm, was also pulled into the scandal and collapsed as a major auditing firm. The case shook confidence in corporate America and raised major questions about accounting, auditing, and executive oversight. The deeper lesson of Enron is about incentives and control. When leaders are rewarded for short-term stock performance and public image, they can become tempted to protect the image at all costs. Healthy companies need breaks. They need people who can say no. They need boards that ask hard questions. They need auditors who challenge assumptions. And they need systems that make hidden risk harder to hide. Enron had too much acceleration and not enough control. That combination is dangerous in any company. Visual, boardroom, compliance checklist, broken brake metaphor. That is why Enron still matters. It is not just an old scandal. It is a warning pattern. Whenever leadership is treated like genius instead of being questioned, remember Enron. Whenever profits look great, but cash flow looks weak, remember Enron. Whenever debt is hidden behind complex structures, remember Enron. Whenever the story becomes more important than the system, remember Enron. Because the names change, the industries change, but the pattern returns. Enron looked powerful. Enron looked brilliant. Enron looked safe. But it was not safe. It was a warning that numbers can be engineered, a warning that trust can be abused, and a warning that when a company builds success on illusion, collapse is only waiting for the truth. If you want more corporate collapse and financial scandal breakdowns, subscribe to the Case Study Lab. And if you create finance or business content, check the creator resources linked in the channel bio.